welcome to today's lecture. My name is Uzma and I'll be taking today's economics lecture. Before I get started on the actual content though, I want to give out sort of an introduction to the people that are making these lectures possible. So that is actually ATAR Notes. So ATAR Notes have been operating since 2007, which is a very long time, and their main aim is to provide heaps of free resources to students and basically enable them to achieve success in their studies. So since 2015, ATAR Notes has been providing these free lectures for the past few years. They've been online for the most part because of COVID. However, we have had a resurgence of some of the in-person lectures as well, which is really exciting. And for the first time, we're actually trying out a new system where we're doing recorded lectures as well. So this one is recorded, and then it's going to be followed up with a Q&A as well. So let's get started. If you are interested to hear more about ATAR Notes, of course, the link is right there for you to access. All right, let's get started. So a quick rundown on some of the free resources that ATAR Notes are providing. Well, we've got hundreds of downloadable study notes, which is always so useful. Saves you the time and effort of doing it yourself, especially if the content is similar, so you can just sort of use those notes. Lectures like this one, where basically experts in the field are able to come out and share their knowledge in relation to their subject and how to achieve success in that subject. Discussions, so online Q&As, etc. Videos, so a lot of engaging online revision as well to sort of mix it up a little bit rather than just have like loads and loads of notes. Newsletters, the ATAR calculator, so if you've got a specific ATAR goal in mind, this can be really, really useful in terms of aiding you to success in terms of, what sorts of marks do I need to get for my subjects. Articles with study strategies and tips and tricks, etc., and heaps more. So if you are interested, please go onto our website, atarnotes.com /register to get access to these resources. And we've also got some paid resources which are really, really beneficial and really, really helpful. So TuteSmart, which is our online tutoring program. So this is done by elite recent Year 12 graduates who basically just, know their subjects inside out and can help you out with that. Study guides, so this is printed revision materials with top tips to help you get great marks. And finally, Ed Unlimited, so this is hundreds of top study guides all in one place for you to access as well. So please do check out these resources as well on the same website if you're interested. And a special thanks to our sponsors. So we've got La Trobe University, RMIT, Deakin, UTS, and Macquarie University. So thank you so much to our sponsors for making these lectures possible. All right, moving on to our actual lecture for today. So we've got the April online lecture, and so today we will be going through a range of different things. An overview of exactly what we will be going through includes the current economic news as well as HSC economics and what it consists of, and then we'll start to go through Australia's place in the global economy and run through a few different topics related to that. And then to end off today's lecture, we will also be going through exam tips and tricks, which are always really beneficial and helpful for students to sort of take insights into how they can perform at their best level. Alrighty, so let's start off with current economic news, because I know this is something that a lot of students have questions in relation to, because remember that in one of your sort of checklist points is to have a contemporary economic understanding. So you want to have an understanding at a deeper level, and also recently we've had COVID, right? So how can we integrate COVID also into our economic analysis, and how does it impact your economic analysis for your essays, etc.? So something to have a think about. All right, so Do I need to read the news? Yes. The short answer, yes, right? You do need to read the news because the news is going to enable you to achieve success in terms of your essays and your economic analysis. If you don't know what's going on in terms of the economy right now, how are you going to talk about the contemporary economic issues and how are you going to demonstrate your understanding of contemporary economics? Okay, so you need to be reading the news, you need to be keeping up with it. What I like to do in my tutoring sessions with TuteSmart, because I tutor economics and business studies. So in my economics sessions, I will always dedicate a bit of time at the start of each session to essentially enable success in terms of going through economic news and going through exactly what needs to be what's basically occurred in the past week, how we can provide those news updates, and then if students have any questions, that's where they can bring them in as well. And if they've got anything to add as well, it's always helpful to have a discussion as well. So, in longer responses, you must include examples to back up your theory. That's where your news readings will help you a lot. It's similar to using quotes in English, right, to back up your response. It's only about 10 minutes a week, right, to just come up to at the end of the week just collate a bunch of updates in the news. Articles by Ross Giddens. We've got Sydney Morning Herald, ABC News. The Apple News app is a really good one. You just sort of tick economics news or business news, and then you'll get updates if you turn on notifications as well. SBS is a great one, and the RBA, the Reserve Bank of Australia, they provide great updates and great stats as well. Then swiftly moving on to stats. So a lot of the time I get the question, how current do my stats need to be? So you don't really need to know stats pre-1990s. So you can sort of ignore that. I mean, you can sort of know some of the recent events from like the 1980s, etc. Just an overall or overarching idea of what actually happened during that time, but you don't really need to know specific stats pre-1990s. You should also avoid giving current examples from pre-2018 unless you have no other choice but to do so. So 2019, 2020 is generally accepted as current. We are currently at 2023, so if you can obviously try to get it as close to 2023 as possible, obviously that is the best option for you. But if you don't, then the general rule is whatever you have available you can sort of talk about. HSC paper is written around the middle of each year, so they won't expect all the stats to be super recent, but if you can, just try to make sure that you can accommodate to that. Yeah. And then stats you must update include the cash rate, of course. The cash rate changes every first Tuesday of the month. So of a new month, the first Tuesday that comes up, the cash rate is updated. So either stays the same, goes up, or goes down. Recently, we've had a lot of cash rate hikes, so that's something you could talk about. But obviously, you need to make sure that that is the most up to date when you are in your assessment, your exam, whatever you're doing. Economic growth rate as well as the US dollar and Australian dollar exchange rate. So the RBA snapshot is a really, really, really good indication of a way to do that. So literally just type into Google RBA snapshot economic indicators and you literally get a PDF of literally all of the recent updates, which is really, really helpful. So I would highly recommend that you have a look into that. So how can I remember it all? This is another question that I get asked a lot. So one way is to tie in with theory. That's a really, really great way to do it. So whilst you're going through theory, then you can sort of integrate in your stats because it will make sense to you because you're going through the theory and then you go, oh, well, here's an actual real life example of when that happened. You can color it differently to your notes in order for it to stand out, like maybe put a star, maybe highlight it, use a different colored pen, whatever works for you. And summary tables and graphs. This is something I utilized very heavily during my HSC time. So the mining boom, GFC, current stats, whatever it is, make it into a summary or a timeline so you know exactly what happened when, and so you have access to sort of a summarized version of that, which is always helpful. Okay, Moving on. So, how does COVID-19 impact your economic analysis? So, what has COVID actually caused economically? Well, going into 2020, Australia had worsening economic performance without considering the risks of COVID. It's actually the worst performance since the GFC, the global financial crisis, which occurred in 2008, because there was weak spending, weak investments, and not a lot of investments into the economy. Economic growth forecasts repeatedly were cut by the treasurer, so there were quite a few issues leading into 2020 before COVID even struck. And then COVID struck, and 1/3 of the IMF member countries were impacted. So IMF is the International Monetary Fund. So there was about 50 billion US dollars in emergency funding that was provided. So it really shows the scale at which COVID impacted economies around the world. So a well-structured, large enough stimulus package could save us from a recession, like it did in 2008. So right now, the biggest threat isn't the pandemic; it's the panic that comes with the pandemic, and that was said by the Ernst and Young chief economist. So it really greatly summarizes how exactly COVID-19 impacted the economy. It wasn't really the pandemic, but it's the panic that comes with the pandemic, right? So 320 billion plus to combat the economic impact of a coronavirus. So it was literally the biggest economic lifeline in Australia's history. That was according to the then Prime Minister Scott Morrison. So stimulus represents about 16.4% of GDP, which is a really large amount of GDP, right? Like think about it in terms of how large a GDP is, and 16.4% of it was a stimulus. So you can see just how large the impact is with supporting 6 million workers and around half of the Australian workforce. So that is a very large scale impact to consider. So these are just some stats. You can obviously research your own stats to help with your economic analysis and deepen your economic analysis, but that is a great start to do so. Another overview of where we're currently at. So, Australia has been faced with bushfires, floods, pandemic in a very short time span. So, a lot of things have happened within a very small amount of time. So the ability for the government to avoid a recession is close to nothing at that point, right? So think about it when we're looking at the 2020 to 2021 lens. So you should be focused on policies to help mitigate the downfall of these events, right? So what cause these? What can we do to mitigate these events from having an impact on the economy and help protect against future events as well, right? So think about this policy. Think about the monetary policy, the fiscal policy, the government policies that have been implemented, right? Approximately 20 to 30% of your study of economic news may be about COVID. But remember that other events are also of equal importance as well. So you can talk about other events, and you're encouraged to talk about other events as well. Okay? So thinking about the labour market, low unemployment due to lockdown rebound from recent times, and right now we are also facing quite low unemployment. So that is something to consider when we're thinking about the labour market. When we're thinking about interest rates fell to a record low of 0.1%. And think back to monetary policy and the impact of monetary policy when we have very low cash rates and interest rates. What does it mean? Right? It means that there's an encouragement of spending, which is what they really wanted during the COVID period. Now, as I mentioned earlier, we're facing a lot of rate hikes, so the interest rates and the cash rates are going up dramatically. The board took this decision to support the economy as it responds to the coronavirus outbreak. So this was the release after the record low of 0.1%. Just to identify right now that the rates are pretty high. They are hiking up every single month. So definitely that is done to combat inflation in recent times. So it won't be increased until underlying inflation and unemployment are sustainable and stable. So that we're seeing now, right? So now we're seeing the rate hikes. And current account, so Australia's current account surplus increased by 13.4 billion to 14.1 billion in the December quarter in 2022. So there's been a surplus trend since 2019, and national investment has fallen, which is a sign of economic weakness, right? So when other countries are not investing into Australian businesses, it's not a great sign for the economy. All right, so that concludes the sort of overview of our contemporary economic understanding. We're now going to move into the content component of today's lecture. So we're going to go into Australia's place in the global economy. So we're going to look at theory, and then we're also going to look at examples and stats. So let's get started with that. So the first thing we're going to look at is syllabus outcomes. So there are three specific areas that we're going to look at. The first one obviously is Australia's trade and financial flows. Then we'll move into exchange rates, and then we'll move into free trade and protection. So let's get started. So value composition and direction of Australia's trade and financial flows. Essentially, what is Australia trading, and where are our financial flows? Where is our money going? Where is our money coming in? So Australia is known as a small, open, attractive, and wealthy economy. We are an economy that is quite successful for the most part. We produce about 2% of the world economic output and 0.003% of the world's population. So we're not really that big in terms of the population, but we do produce quite a bit of world economic output, 2%. Okay, so Australia's trade balance is currently positive at about 3 billion. So Australia's major trading partners up until the 1960s was the UK, which is about 50% of exports. So Japan was the biggest export market between 1975 and 2005, and China rose during the post-mining boom period. So mining boom occurred in 2003, so after that, about 2005, we saw that they contribute now to about 30% or even more of Australia's exports. Remember, these stats are always changing, so I would highly recommend that you constantly update them, even now, going into your assessments and exams, etc. So Australia has a comparative advantage in three things. Commodities, this is by far our biggest. Agricultural products, so anything like our wheat, our beef, wool, etc., and services, so tertiary education, inbound tourism, all of that has now been growing. So commodities has always been there since 2003, since we had our mining boom. Agricultural products also has been a major part of our comparative advantage, so what we have an advantage in as a country. And services is something that has slowly started growing. However, we can see here it says inbound tourism. That's sort of slowed down during the COVID period. So it's starting to boom back up, as well as tertiary education. A lot of international students were not able to come into Australia, etc., during the COVID period. So Australia manufactures niche, sophisticated products. So think about medical equipment, pharmaceuticals, processed foods, and they import anything that they can't really sort of produce on their own. So cars and petroleum, those are often imported from other countries, as well as overseas travel, obviously, right? So that's money going into other countries. Sometimes it is said that we have a narrow export base, so we don't have that much that we're exporting out to the world, which is limiting us as a country to achieve a higher revenue. And that is often a criticism that Australia gets in terms of our trade patterns. But the economy is reasonably resilient. Like, we have been able to combat many negative events that have fallen upon us, like COVID, etc., right? And we're still able to achieve success with our current narrow export base. So there's been about 28 to 29 years since Australia's last recession, so that's a really good sign, and it's honestly an incredible achievement as a country to have avoided a recession in the midst of GFC, in the midst of COVID. 1980s, there were reduced levels of protection, encouraging exports and imports, etc., which is why we're able to see such a incredible feat of globalization take place and be able to trade with other countries so freely. So Australia's trade as a percentage of GDP actually increased from 12% in the 1980s to about 21% in 2017. So you can see the difference, right? That stat is in there to really just highlight the difference between how much we were trading and versus how much we are now and how much it's contributing to our revenue as a nation. Alrighty, so then going into trends in financial flows. So we've talked about trade. Moving into financial flows, we've got debt and equity. If you are not already aware of the difference, debt is just money that is borrowed. So if I go to the bank and I borrow money, I borrow $100,000, that is debt, right? Whereas equity is my own money or the money of the other owners, investors. Okay, so a really important note to go back to when our system was deregulated. So our financial system was deregulated in 1983. So that's when we had the floating of the exchange rate. So it essentially meant that there was greater accessibility of Australian firms to world capital markets, right? So there was higher integration. We were just able to more freely access the financial system, whereas previously there had been a lot of rules and regulations and red tape surrounding it. So the foreign direct investment in Australia and investment overseas by Australians has doubled in the past decade. So a lot of the investments have gone up dramatically. So that is always a good sign for Australia because they're able to then use that money to grow even further. So the top international investors from Australia has shifted from commodity companies in the 1990s to the service sector now. The Australian dollar is the 5th most traded currency in the world. So that puts us in a great position. So thinking about equity. So we've got net foreign equity, which is the difference between foreign investment and investment, right? So basically 1 minus 2. 1 is over here and 2 is over here. 1 is our total value of foreign owned assets in Australia, minus out the total value of assets owned by Australians overseas. And then what you're left with is your net foreign equity. Okay, so direct investment, essentially how we define a direct investment in economics is that it is a substantial investment. So you substantially invest in an existing business or a brand new business overseas. And how do we actually define substantial? It's always above or greater than 10%. Portfolio investment, on the other hand, is quite the opposite. It is a smaller proportion, it's less than 10%, where you're having a small investment into a range of different assets, whatever. So normally the way that you are able to tell is direct investment, if you are directly investing in a business and it's more than 10%, normally that person wants to really have a role in the business, whereas portfolio is just like a little investment. You don't really want to have a role, but you're just sort of investing in order to gain some returns. Okay. And then we've got on the other hand, we've got debt, right? So net foreign debt is the difference between loans, so 1 minus 2 again, total value of foreign loans to firms or banks in Australia, so borrowing by us and lending from us. So that's minused out, right? So the total value of loans made by Australians to firms overseas. So what is net foreign liabilities? Essentially, the way that you get it is your net foreign equity, which is from the previous slide, plus your net foreign debt, which you get from this slide. So what foreigners owe divided by, or sort of not divided by, but what foreigners owe or what they contribute to our economy. Okay, so having a think about that as an overall concept, and we'll talk more about that when we do get to the balance of payments, which we're on now. So balance of payments is the record of transactions between Australia and the rest of the world. Simple. During a given period of time. So how much money is going into the Australian economy versus how much money is leaving the Australian economy. The money that is going in is known as a credit, and the money that is leaving is known as a debit. Okay? The attraction for foreigners is that they can own the business in a country that has a stable function, right? So yeah, that's fine. All right, so this is quite important. So structure is that we've got current account plus capital and financial account, which makes up your balance of payment. So you've got two main accounts, and this sort of table over here is a great summary of exactly what that involves and what that consists of. Okay, so current account, you've got your net goods and services, which is your exports minus your imports, your net primary income, which is also summarized to be MPY, or acronym is MPY, and your net secondary income. That is your current account. That's it. And then your capital and financial account, you've got your financial and your capital investments. So these two accounts will always equal 0, right? So this will be, for example, this will be 5 million, then this will be minus 5 million, and so that will give you 0. Then you've got net errors and omissions. So if it doesn't equal 0, then the amount will then be changed, and so that will force it to equal 0. So if there is a current account deficit, then there must be a capital account surplus. Okay? So the idea that if one account is in a deficit, the other account must be in a surplus. This one's in a surplus, this one must be in a deficit. Because again, it should always equal 0. So current account, this reflects the current transactions, it's in the name. So transfer of payments or income, which are non-reversible. So let's go through each component in the current account. So the first one is your BOGS, which is also known as the balance of goods and services, which is essentially your exports minusing out your imports. So it's the difference between the number of goods and services you export and import. Simple as that. So that's why it's called the net goods and services, or the balance of goods and services. Okay, so that is your first component, okay, over here. Second component is your net primary income. So this is your earnings on investments, right? So think about the income that is earned from a return of a factor of production. Remember how we have the 4 factors of production? So any return from that, for example, land, you get a return from rent, right? Entrepreneurship, you get a return as profits, okay? Income, etc. So when foreign companies invest in Australia, the profits flow back overseas. Think about it, right? You're investing into Australia, that money is then going to go back to overseas via dividends or returns. And then when Australian businesses invest overseas, again, the same thing applies, right? The money then flows back to Australian businesses. And then the third sort of component of the current account that we have is known as the net secondary income account. So this is your non-market transfers. So this is income that is not earned through a factor of production, and so a small part of the current account. For example, remittances to relatives, the money that's given to relatives, etc. So anything that doesn't really fall into a factor of production area, it will then fall into net secondary income. So those are the 3 main components of the current accounts that you need to remember. First of all is your balance of goods and services, second is your net primary income, and the third is your net secondary income. So so we've talked about the idea of the current account. So if there is a current account deficit, normally it's measured through a percentage of GDP, so how much of the percentage of GDP is the deficit. In the long term, a current account deficit of 3% or less, and in the short term, a current account deficit of 5% or less is sustainable in terms of GDP. So first current account surplus was about $6 billion, which was in 2019 since 1975. So Australia is getting less investment from foreigners. There's been increase in commodity prices as well, and lower imports from weaker consumer confidence as well. So not a lot of people are actually buying from overseas in Australia. Not a lot of people are buying from overseas. So that all sort of contributed, all added up together to create a current account surplus. So let's do an example of how to actually calculate the current account balance. So first component is your balance of goods and services. So if we have exports of 350 and we have imports of 250, then what is going to be our balance of goods? Right, this is particular to goods, and then same thing for services. What is our total balance of services, and then what is our balance of goods and services combined? Right, so have a think about that. So I'll give you the opportunity to just pause the video now, and then have a go at putting in your answers, and then once you're ready, just unpause and we'll go through it. All right, so the answers are up on the screen. So 100, so you do 350 minus 250 to give us 100, 150 minus 200 to give us minus 50, and so you're left with a positive balance of 50 in the balance of goods and services. Okay, as simple as that. The next part, net primary income, is minus 250, net secondary income comes up to 50. So what is the current account balance? That is what we want to figure out. The answer is minus 150, right? So you simply add them all together. So current account deficit of $150 million and a current account surplus, a capital account surplus of 150 million, right? So because one is negative, the other has to be positive. So if you're ever given a question where you're told basically that the current account deficit is 150 million, what is the capital account? It's going to be a surplus of 150 because the current account is in a deficit of 150 and always needs to equal to 0. Alrighty, moving on to the next component. So now we're looking at the capital and financial account. This records the foreign financial and investment transactions. So borrowing, lending, sales, purchases of assets, etc. So any of the reversible transactions. So capital outflow, the purchase of a foreign asset. Capital inflow is the sale of a domestic asset to foreigners, is a capital inflow, essentially. Right? Think about what money is leaving, what money is coming in. There are two components to the capital and financial account, the financial account and the capital account, right? Simple. Financial account, we look at debts, so for example, loans, and equity, for example, investment transfers. And then the capital account is your non-financial transfers, so that's literally just related to copyright claims, things like that. Capital transfers, so foreign aid, net acquisition, disposable of assets, etc. So like that sort of combines to create your capital account. Okay, so remember there are two accounts in your capital and financial accounts that you need to be able to differentiate. So links between the key balance of payments categories. So Australia's persistent current account deficit previously generally reflects a higher rate of international investment. So we have a lot of investment into Australia. So individuals invest into housing, for example. A bank lends the individual money. Bank sources money from overseas, and then the money enters into the capital and financial account. Again, think back to the fact that we've got loans in the financial account component. And then that money flows back overseas when interest is paid to the overseas lender, right? And then that's recorded on the current account as a deficit. All right, so that's why we often have persistent current account deficit. So IKEA, Aldi, Google, etc. all invest into Australia, so that money enters in through capital and financial accounts as a surplus because it is an investment. And then that money flows back overseas when they make a profit, and then they send some back to the headquarters overseas, so that's going to be recorded as a current account deficit. Okay, because remember, profit is a return on the factor of production as well. All right, so hopefully that's kind of making sense. So I've provided a few examples to sort of clear out doubts and hopefully allow it to make more sense to you. Here's another summary of basically what we've gone through, so feel free to have a look into that if you are sort of still a bit confused, and hopefully that will provide a few more insights into what I'm talking about. All right, so factors that contribute to the current account deficit. So we've got two types of factors. You've either got your cyclical factors and then you've also got your structural factors. So your cyclical factors, essentially think of the economic cycle or the business cycle, they vary with economic activity. So these include things like the exchange rate, the terms of trade, domestic economic growth, international business cycle. These all change with the level of economic activity going on. And then you've got the opposite hand, which is your structural factors. These are more long-term. So these basically are related to the structure of Australia's economy. So what is Australia's economy based on? What is it like? And that those factors actually influence at the end of the day as well, the current account deficit. So the fact that Australia is an open and safe economy, that we have low value exports such as mining products, that we have high value imports such as our electric goods, technology, because we don't produce them here. We don't have a comparative advantage to produce them here. Right? So cuts in protection, such as tariffs for local industries over the last 30 years, low rate of domestic savings, etc. Okay. So I know definitely the savings has gone up. Again, would highly recommend to go through the economics indicator snapshot from the RBA to provide the most recent updates in terms of where we're at in terms of household savings and all of the important stats that you need to know. All right, then moving on to terms of trade. So this is a relationship between export prices compared to import prices, right? So a better terms of trade is achieved by either a higher export value or quantity or a lower import value or quantity. So, according to DFAT, during Australia's mining boom period, the terms of trade reached the highest levels in sort of 140 years, which is a very long time. So, we know that the mining boom period was definitely a very influential period in Australia's economy. Movements in the terms of trade have a significant influence on the balance of payments and the living standards of a nation. So, really, it's quite important to take that into consideration when we are considering economic analysis to consider the terms of trade. A quick summary of how to actually calculate terms of trade, because you often will get questions in terms of that, is simply terms of trade index is equal to the export price index divided by the import price index times by 100 to give you your terms of trade index. All right, now we're going to go through an example. So again, I'll get you guys to pause the video here to have a go at filling in the numbers for from year 1 to year 4, and then we'll reconvene and go through the answers. Okay, so pause the video now. I'm going to move on to the next slide. So the answers, simply you just plug in the numbers there. So 100 divided by 100 times 100 to give you 100. Again, do the same thing for every single year. From your export divided by import times 100. Okay, so and then if the question asks you what does this actually mean, that's where you would then go in and describe the trends. So for example, it's favorable looking at year 3, year 4, or unfavorable when we look at year 1, year 2. Okay, so rule is the higher the number, the better the index. So make sure that you know what the terms of trade index actually means so that you can then successfully be able to talk about the trends and what the terms of trade index analysis looks like. All right, so that concludes our first topic, which is Australia's place in the global economy. We're going to now end the financial and trade flows. We're now going to move on to the second topic, which is related to exchange rates. And so what exchange rates are, what do they mean, etc. So we'll get on to that now. All right, so the first thing to have a think about is what exchange rates actually are. So exchange rates are the price of one country's currency in terms of another country's currency. So it's essentially the value of currency that's explained in terms of another at a given period of time, right? So if you've ever gone to another country, you've ever traveled to another country with a different currency, you might have actually dealt with exchange rates because you have to convert your money from the Australian dollar to whatever currency you're going to need for whatever country you're traveling to, right? So the currency conversion usually occurs in the foreign exchange market. So to conduct trade and investment between countries, it is absolutely necessary to convert currencies, right? Because obviously if a business in the US is investing in Australia, they are not going to use the US dollar, they're probably going to use the Australian dollar because it's an Australian company. So Australia has had a floating exchange rate system since December of 1983. So for a very long time, we've actually been operating with a floating exchange rate system, and we'll talk a little bit about what exactly that means and what we need to consider in terms of that. and what that means for Australia as well. So before we get onto that, we're going to quickly have a look at the measurement. So there are a few different ways that we can measure exchange rates. First one is to other individual currencies, which I'm sure most of you are already aware of. So there is not one single exchange rate for Australia. There are many exchange rates. In terms of whatever countries and currencies Australia deals with. So we have an exchange rate for the Australian dollar and the US dollar. So, for example, 60 Australian cents will buy you, let's say one US dollar is equal to 60 Australian cents, um, and etc. So that's one example, and you'd have the same thing for every other country, right, that we want to have an exchange rate with, essentially. So bilateral, which means two countries, or cross rate is one country in comparison to another. So it is possible that against the other currencies, the Australian dollar may be going up or it may be going down. So this is the most common form of the exchange rate. So if I'm traveling, for example, let's say I'm traveling to New Zealand, then I will get the New Zealand dollar and use the exchange rate between Australia and New Zealand. So that is the first type. The second type we have is called the TWI, or the Trade Weighted Index, and that is actually created a concept that was created by the RBA, the Reserve Bank of Australia, and this is essentially measuring the movements of the Australian dollar against a basket of different currencies that Australia trades with the most. So think about so rather than comparing to countries that we don't really trade with, or we don't really have an exchange rate with, we don't really communicate that much with them or go to those countries that much, those countries are excluded. So we're exclusively focusing on the countries that are leading trading partners. And then they're weighted according to significance of Australia's trade. So think back to when I said that right now Japan is, China. Japan was previously one of our largest trading partners, but right now it's actually China that is our largest trading partner. So their weightage is going to be a lot higher than Japan, who is not that prominent anymore. Okay, so it provides a much better overall picture of the value of the Australian dollar, as well as an accurate measure of the Australian dollar, because we're now just comparing to trading partners that we trade the most with. So our leading trading partners, so it's trade weighted essentially. So however, the TWI is limited in that it is calculated using the volume of trade with other countries, not necessarily the currency in which trade occurs. Okay, so that is something to have a think about as well, and that's a potential limitation. So if you're asked to discuss the TWI, then you have, there we go, a positive, and you also have something as a disadvantage or a limitation that you can also talk about. For example, the significance of the exchange rate with the USA and Japan has declined, while the exchange rate with China has become more prominent. So it reflects who we are trading with in the global economy. So an increase in the TWI means that we have a stronger Australian dollar compared to the currencies of our trading partners, and decrease means the complete opposite. So the above 2 points are commonly tested in multiple choice, so please make sure that you do know them. Alright, so then we're going to move into the factors that impact supply and demand of the Australian dollar. So demand for the Australian dollar is essentially represented by all of the people that want to buy the Australian dollar. So therefore increase demand, right? And supply of the Australian dollar is how much supply there is of the Australian dollar. So people who want to sell out the Australian dollar, they don't want the Australian dollar anymore. So an increase in the value of the country's exchange rate is known as an appreciation, and a decrease in the value of the country's exchange rate is known as a depreciation. So you've got two really important terms that you want to make sure that you really understand, right? So increase is we're looking at appreciation, decrease, depreciation, okay? So now let's have a look into what actually impacts the demand for the Australian dollar. So demand for the Australian dollar is represented by all of those people who want to buy the Australian dollar, right? Think back to previous slide, right? Think of it as a foreigner. So let's say a foreigner is coming into Australia. They are traveling to Australia for a holiday. So they are traveling, let's say they're traveling from New Zealand. So currently they have the New Zealand dollar. They need to transfer that, or they need to exchange it for the Australian dollar, because when they come into Australia, they can't go into the Woolies store and pay in the New Zealand dollar. They need to pay in the Australian dollar. So the demand for the Australian dollar relates to inflows on Australia's balance of payments. So think about it. First thing, the size of financial flows into Australia from foreign investors who wish to invest. Right, so that's one example. If you are living in the US and you want to invest in Australia, you're not going to invest in the US dollar, you're going to invest in the Australian dollar because you are investing into Australia, right? So an Australian business will require the Australian dollar. Australia's interest rates, so a high domestic cash rate will mean that you're going to get higher returns as a foreigner, for example. So that may encourage you to go and invest into Australian banks, etc. So that's going to increase again the demand for the Australian dollar. Third one that we have is expectations of a future appreciation of the Australian dollar will increase demand by speculators. So think back to what does an appreciation of the Australian dollar actually mean, right? Okay, an increase. Will increase demand by speculators, because speculators will then invest more into Australia because they believe that the value of the Australian dollar will rise. Demand for Australia's exports. So if there is a lot of demand for the goods and services that Australians and Australian businesses are selling, then the people that are buying them will obviously have to pay with the Australian dollar. That will increase the demand for the Australian dollar. Australia's international competitiveness, so if exports are cheaper, that is something that will significantly influence the demand as well as changes in the global economic conditions. So world economy is an upturn, then the demand for exports will increase, and again, we talked about that earlier, what that means, right? And then you want to think about the complete opposite when we think about supply. So everything that applies for demand still applies for supply, it's just switched, right? Because now we don't want the Australian dollar, we're trying to sell the Australian dollar. So think of it as an Australian. Let's say you are traveling to Greece, you're not going to no longer need the Australian dollar when you go to Greece, you're going to need the currency that they use in Greece. So supply for the Australian dollar relates to the outflows on Australia's balance of payments. So for example, the size of financial flows of Australia by Australian investors who wish to invest overseas. Okay, so they need to sell the Australian dollar and they need to purchase foreign currency as well, like we just talked about. Australian interest rates relative to overseas interest rates and what they actually mean. So a low domestic cash rate, for example, will mean that fewer people want to save their money in Australia because they won't get as many returns via interest. Expectations of future depreciation of the Australian dollar. So speculators will sell the Australian dollar and that will contribute to the depreciation of the Australian dollar even further. Demand for imports. So if there is a higher demand versus a lower demand, that will impact the supply. And finally, payment for servicing costs, of servicing costs or foreign debt for Australian businesses. So these are some things to think about, but essentially it's just flipped over. So yeah, there we go. There's a big summary of exactly what an appreciation and depreciation in the next slide mean. So appreciation is an increase in the value of one currency in terms of another, and a depreciation is a decrease in the value of a currency in relation to another. So literally the only difference between these two is increase and decrease. And very easy to remember because decrease, depreciation, easy. Alright, so now let's go into sort of a quick table. This is something we already just discussed, but again, just to summarize, so factors that cause an appreciation of the Australian dollar, increase in demand means that there's demand for Australian exports is increasing. There's a higher domestic interest rate like we talked about, higher tourism, etc., like we have discussed earlier. So I don't want to spend too much time on that. Decrease in demand for imports when there's a decrease in supply. And then we've got decrease in the overseas rates, decrease in overseas tourism, etc. So that means that there's a decrease in supply, increase in demand, which are essentially the same thing. So Essentially, we've got increase in demand, so they are both going to push a decrease in supply. They are both going to push from the price up, right? So, or the exchange rate up. So increase in demand, so it's going to shift to the right, whereas decrease in supply, it's going to shift to the left, the supply curve. Okay, so hopefully that is making sense. I will give you a second to pause and just note or draw these graphs in because they are really, really important and they will really help you out in terms of just being able to articulate your analysis better and form your analysis better in an essay, etc. So this is really good to draw into an essay, etc. So I'll give you a chance to note that down. All right, so fixed exchange rates. So there are a few different types of exchange rate systems that are used. Like I mentioned earlier, Australia uses a floating exchange rate system. So that is something that we will discuss in the upcoming slides, I believe. Yep. So yeah, so first one we're going to look at is the fixed exchange rate system, which Australia actually did have in the past. So the RBA or the government, central bank, officially will set the exchange rate. So no factors of supply and demand are considered here. So from 1932, Australia's currency was pegged to the UK pound. And then changed to peg against the US dollar in 1971. So essentially, this means that whatever the UK pound was, that was also the Australian dollar value for the day. And then in 1971, whatever the US dollar value was, that was the same thing for Australia. So it was a fixed rate. So the exchange rate was then fixed to the trade weighted index, which was created by the RBA. But then in 1983, like I mentioned earlier, the Australian dollar floated. So there was no longer any consideration of a fixed rate. So there are no market forces with which a fixed exchange rate is impacted. Like there's no supply or demand, like I mentioned earlier. It's just simply pegged to whatever currency. So the RBA or the government essentially would maintain the rate by buying or selling the Australian dollar to make it the desired level, right? So whatever the rate was, they would sort of adjust it artificially, which is completely different to the floating system that we have today. So that is something important to note there. That in the past we had a fixed exchange rate system where it would essentially be pegged to another currency. However, the RBA needs a very large reserve of forex to every day buy and sell the Australian dollar and make it and adjust it to suit that. Therefore, the central bank may face the risk of actually running out of forex and not be able to have enough to buy and sell, right? So the advantage of the fixed exchange rate system is that it actually increases exchange rate stability, right? So it's a more stable rate, right? So it's basically been determined because it's been pegged. And so it's quite stable because they sort of know what's upcoming. Whereas when we have a floating exchange rate system, there is a lot of instability because you just don't know what the market forces of supply and demand are going to do. One day it could be one exchange rate, the next day it could be completely flipped on its head and completely different. So that is something that basically bolsters great uncertainty in the Australian economy nowadays because of our floating exchange rate system. So yeah, the fixed exchange rate fixed exchange rate system brought about great certainty for businesses and those that are trading, etc. So that was really good for them in terms of the fact that it brought along a lot of certainty. Depreciation only occurs under a floating rate system. So remember that under a fixed exchange rate system, there is no such thing as appreciation. Depreciation is just essentially just pegged to whatever currency it is for the day. So if exchange rate is fixed, a depreciation is known as a devaluation or a revaluation because again, it's determined by the people, by the governmental, the central bank or whatever pegged rate it's at. So really we can't call it appreciation, depreciation because it's not in accordance with the market forces of supply and demand. So here's an example we've seen, and this is a limitation to the fixed exchange rate system in that we really can't determine, or we can't really say that it's the market rate. So it's unnatural, it's artificial, and you're changing it, right? So if the market rate was actually 80 cents and your fixed rate is at 90 cents, we can see that that's a 10-cent difference. And so when everything is not in accordance to natural forces of market, the natural market forces of supply and demand, then it's going to lead to problems naturally because it's artificial. You're messing with the natural system of what the rates are, right? So that's something to take into consideration. So fixed exchange rate system, what are some advantages and what are some disadvantages? So advantages are definitely the certainty for investors, right? So there's less volatility and there's less volatile rate, which is always great for businesses in terms of their trade, etc. There is generally less speculation because there's nothing to speculate about. Really, it's just a revaluation, devaluation. It enhances the international cycle by fixing at an undervalued level, right? So can be set at a level that helps to address specific problems in the economy. So whereas now in a floating rate system that just won't happen. Like we can't really set the rate to something specific to deal with COVID or to deal with the bushfires or the floods or whatever. Like it's just going to be natural market forces. So if it's believed to be too high, it can be undervalued as well. Whereas nowadays we don't have that concept because again, we're not undervaluing, we're not devaluing or revaluing. We're simply just looking at the market forces, and then they'll determine what's going on. So disadvantages we've got is unresponsive to changing economic conditions. So really, yeah, what the previous slide highlighted was the fact that, you know, it doesn't really matter what conditions are going on, they're just going to set it to whatever rate they prefer or they'd like. It causes quite a few inefficiencies as well, so that can cause quite a bit of an issue. There's a high level of forex that is needed to maintain the rate. So again, that's something we discussed. So if they've run out of forex, it's going to cause quite a bit of trouble. There's a constraint in terms of global free trade, and significant speculative capital inflows can occur. Sorry, not inflows, flows can occur. And the process of supporting the currency affects the domestic money supply, right? So the idea of you're artificially buying and selling the currency, but that's just not natural, and so that's going to impact essentially what is the natural domestic money supply. Okay. So hopefully that's making sense. Feel free to pause here and note down anything that you do find relevant. All right, moving on to the next slide, which is the flexible floating exchange rate. So since 1983, Australia has actually operated under a flexible exchange rate, a floating exchange rate, like I've been sort of hinting at throughout the lecture, whereby market forces of demand and supply determine the equilibrium price of the Australian dollar in terms of any other currency, right? So yeah, it's essentially up to the market forces of supply and demand, which means there's a lot more volatility. This means that the equilibrium of the Australian dollar will change according to supply and demand and how it fluctuates in terms of global and domestic economic conditions. So the floating exchange rate has provided a buffer against external shocks, particularly shifts in the terms of trade, which we talked about earlier, allowing for the economy to actually absorb them without generating the large inflationary or deflationary pressures that, you know, did come from the previous fixed exchange rate system. So we can avoid those sort of issues now a lot more with the floating exchange rate system because it's now no longer pegged to anything specifically. Right, so hopefully that is making sense so far. Moving on, so while discretionary changes were made to the value of the Australian dollar under previous exchange rate systems, it was very difficult to actually calibrate the adjustments to provide an effective buffer against the shocks that did come about in the economy. So that's something to consider as well, right? So the shift to a floating rate has therefore contributed to the reduction in the output volatility. So it has also enabled the RBA to set monetary policy that is best suited to economic conditions in the domestic economy. Right, so whatever's best for the economy, they can sort of have the freedom to do that and not worry about other sort of issues such as buying and selling forex, etc. So the types of floats include, first of all, we've got a clean float, which is a pure demand and supply. There is no central bank intervention. It's just completely based on supply and demand. And then we've got a dirty float, which means that to some extent it is actually there is central bank intervention. So that is something to actually consider. And in Australia, we have a dirty float. So there is some intervention, and we'll talk about what certain interventions there are, and how they actually do somehow still control to a certain level what the exchange rate is. Okay, so there are two. Okay, before we get onto that, let's go through advantages, disadvantages of floating exchange rate system. So the market forces the market forces determine the price for the Australian dollar that reflects the state of the economy, right? So when we have a look at the price of the Australian dollar, it's essentially, okay, what's going on in the economy? What are the market forces of supply and demand? So if we go back, it is at the market rate. Right, so it exposes the economy and basically assists in making necessary adjustments. We've got better adjusted to external shocks as well, so the terms of trade, the current account deficit, they're all accounted for. The government can pursue a more effective and independent sort of approach, because again the balance of payments doesn't play as much of a role anymore, right? So greater global financial integration as well, of course, and discourages speculative investment. So actually it does it can discourage speculative investment depending on the scenario, but it can actually also more so encourage speculative investment as well. So that's something to note down there as well. So it's sort of in the middle, depending on the situation that you're at. So greater volatility caused by changes in the exchange rate expectations relating to the state of the economy, of course, right? So that's the big disadvantage is the volatility aspect and how that impacts businesses and their trade. Encourages speculation, like I talked about. So because speculators will sort of have a go at predicting, okay, will there be an increase or will there be a decrease in the currency? Subject to shift in market sentiment, as well as valuation effect occurs on the CAD, and to the net foreign liabilities as well. So something also to note down is a Dutch disease, where basically it goes into the idea that a boom in one export industry causes an appreciation, which makes other industries then therefore less competitive. So that's something to also think about under the floating exchange rate system, and how that can cause a few issues or some troubles down the line. All right, so managed exchange rate system. So remember how I talked about the fact that we've got a few different types of systems. So the third one that we're going to look at is a variation or type of the fixed exchange rate system as well. So it's operated in Australia from November 1976 to December 1983. So this is where the RBA would peg the value of the Australian dollar at 9 a.m. every morning, and this consequent price would operate throughout the day. Okay, so simple as that. Essentially like a fixed exchange rate system. 9 a.m. operates throughout the day, and next day again 9 a.m. operates throughout the day. All right, so now remember when I talked about the fact that we've got a dirty float. So it is still, somehow, there is still a bit of central bank intervention. And you may be wondering how this central bank intervention. There's actually two ways. We've got direct and indirect intervention, and we'll talk about both in a second. So the RBA has had some control over Australia's history regarding the influence of the exchange rate, and we know that in the past they did through the fixed exchange rate system. So since 1983, however, the RBA will intervene in the foreign exchange market to smooth out fluctuations in the Australian dollar. So once we've moved into like a flexible floating exchange rate system, obviously we've got a lot of fluctuations, a lot of volatility. So the RBA has been sort of there to influence or intervene in that system as well. So the two specific policies the RBA can use to affect the value of the exchange rate under the floating exchange rate system particularly is number one, to dirty the float, which is direct intervention, and adjust monetary policy, which is an indirect intervention. So let's get into it. The first one we've got is the dirtying the float. Essentially, this is a type of direct intervention. Generally, the value of the Australian dollar is allowed to float cleanly without any intervention, right? So the idea that it's completely operating on the forces of supply and demand. So if the RBA intervenes, then the float is no longer clean. Right, so there's not pure market forces, and therefore it becomes a dirty float, like we talked about earlier. So to appreciate the dollar, what the RBA will do is essentially they will sell forex and they will buy Australian dollar, and that will artificially create demand and it will shift it to the right. Right? And then the opposite also holds true. To depreciate the dollar, they will artificially create more supply because they will buy a lot of forex and sell out a lot of the Australian dollar. And that will shift supply to the right, going back to the graphs here, essentially achieving the same thing. Right, so that is essentially the concept of dirtying the float. Chances are they probably won't do this that often because they just don't have enough Australian dollar, enough forex to be doing that all the time. So a lot of the time that won't take place, but it is an option and it does have the potential to take place. So, example, in 2008, the Australian dollar lost one third of its value against the US dollar, in which the RBA had to purchase 3.3 billion of the Australian dollar to moderate the depreciation that had occurred. As a result, the RBA was able to recover $3.4 billion in 2009 as the currency recovered in value. So, that is an example of a direct intervention. So I will give you a chance to note that down because that is quite an important stat that you can integrate into your essays. Righto, moving on to indirect intervention through the adjustment of monetary policy. So, what is monetary policy? It is essentially the RBA that sets the interest rate to manage the economy, with a secondary function of changing the interest rate difference between Australia and overseas. Right, so the monetary policy essentially deals with the cash rate, which then impacts the interest rate. So if they really wanted, the RBA could increase the value of the Australian dollar through through increasing the level of official interest rates through the DMOs, which are basically like domestic market operations, so dealing with banks and their interest rates, which they then pass on to households and individuals. So the higher the rates are, they would attract greater foreign savings. Why? Because if I'm saving into Australia where there's a higher interest rate, means I will get more of a return on my investment via the interest, whereas another country may not have a very high interest rate. I would not want to put my savings there. So it encourages capital inflow into Australia, right? And then think back to the demand, right? So there's a higher demand for the Australian dollar, and that's going to lead to a increase in the value of the Australian dollar, causing an appreciation. and the opposite holds true. If you want to depreciate the Australian dollar, you want to lower the value of the Australian dollar, what is the RBA going to do? They could essentially lower the value or the level of the official rates in the DMOs, the domestic market operations, and that will essentially lower the interest rates that are lower will encourage capital outflow, so not many people will then be investing into Australia because obviously the rates are quite high. Sorry, the rates are quite low, so they're not getting as much of a return on their savings, so therefore they're going to increase the supply of the Australian dollar. They're going to sell out the Australian dollar. Okay, hopefully that's making sense. Yeah, so essentially that's the idea of the adjustment of monetary policy as a indirect form of intervention that can influence the RBA. So that the influence of the RBA then falls onto individuals and households, etc., and that's going to impact the overall exchange rate. Okay, so that's something you can also note down. Chances are, again, they're probably not going to do this. Like it will probably be an indirect effect. It won't be like something that they do directly in order to influence it. But obviously they're going to increase, decrease, or keep it the same. So indirectly, anyway, they're going to influence it, right? So that's something to keep in mind. But the main idea is that monetary policy aims to combat inflation, not so much exchange rate movements. Although they can be interrelated. Okay, so the theory behind this is that monetary policy is rarely used to adjust, like I talked about, the level of Australian dollar. It is rather, like I mentioned earlier, used to deal with inflation. The RBA stated that the 10% depreciation of the Australian dollar would lead to a 0.25-0.5% increase in inflation over 2 years. So they are related, right? Alright, and that concludes the exchange rate component of today's lecture. We're now going to move on to one of the last components of the content, and then we'll move into tips and tricks and summary. So one of the last components of content that we'll be going through today is related to free trade and protection. So we'll go through that, and then we'll go through some tips and tricks on how to achieve success in economics and what to do to be able to achieve good marks in the subject. So let's get started with free trade and protection. I know it's quite a long lecture, but hopefully you're all still with me. We're almost approaching the end of the lecture, so yeah, not too long to go now. Alright, so let's start off with Australia's free trade policies. So first of all, we want to basically figure out what protection is. Protection is a type of government action, whether that be tariffs, quotas, subsidies, that have an effect on giving domestic producers an artificial advantage over foreign competitors. Okay, so essentially you're protecting your local businesses so that when foreign competitors come into Australia and they compete with the local businesses, that local businesses have an artificial advantage, right? So when asked like why do we actually need protection? What is the justification of this artificial advantage? Some things include protection of infant industries, so new industries that are just starting out, protection of employment during a recession. So making, these local businesses are obviously hiring a lot of employees, so making sure those employees are stay employed essentially during recessions and downfalls in the international business cycle. Protection from dumping of imports into the domestic market below factor or production cost. So essentially we're trying to prevent dumping, which is where, like let's say there's an overproduction of a certain good, they will then dump it at a very, very cheap price, which will impact negatively on local businesses who are making that same product, because then businesses will just go to that like foreign competitor who's selling it at a very cheap price, but it's really not sustainable. Then we've got improvement in terms of trade. So if the exporting country reduces its price for another country's imports. And finally, reducing the balance of payments or the current account deficit. So if protection causes less spending on imports. Okay, so some things to have a think about. The reason I haven't gone into these in as much detail is because they were covered in topic 1. So please go ahead and revise topic 1 if you're still quite unsure or you've forgotten about these. Your textbook or your notes, etc. Like, have a look through them. This is quite a simple concept. Just having like sort of a brief recap on what it is would be beneficial to you for this topic as well. All right, so moving on to free trade. So, reducing trade barriers to what is free trade? Essentially, you're reducing trade barriers, you're allowing trade to occur more naturally, and it's sort of a more open and communicative thing that takes place. So, encouraging countries to specialize in the production of the good and service that they are most efficient in producing. So, this improves resource allocation. If we go back to prelims, remember what the idea of economics is, right? The economic problem is essentially we've got unlimited wants, but we've only got limited resources. So we need to allocate those limited resources to meet the wants that we most want to meet, right? So resource allocation is extremely important. So when we focus on our comparative advantage, like I talked about at the very start of this lecture, how Australia's comparative advantage relates around our commodities and our services, as well as our agricultural products, those things are what we're good at. So we're not going to go and produce, for example, technology, cars, petroleum, whatever, right? And we're just going to focus on those, and then we're going to get the rest of the things that we don't really have a comparative advantage in, and we're going to get that imported into the country. So specialization through economies of scale, as it lowers the cost and improves productivity, which is great for the economy and as well as businesses, right? So businesses lower in cost will increase increase profits, and what higher profits mean is more revenue for the government because they pay more taxes. Encourages innovation and spread of new technology as well. And it leads to higher living standards due to lower prices, which cause an increase in economic growth and provides greater consumer choice. Right? So consumers have more choice now rather than just having one local business that they get their products from. They have a range of different businesses, including local and foreign businesses as well. All right, so trends. The Australian government, over approximately the last 30 years, has removed many protection barriers, giving basically that were given to Australian industries and manufacturers. And so now those protection barriers are gone. So there's no real artificial advantage that is prominent in the economy for local producers. In 1973, for example, 25% across the board unilateral reduction of protectionist policies by the Whitlam government. There's also aimed to promote structural change to increase efficiency, productivity, and competition. So that was something that was sort of encouraged during that time, and something that is still relevant today with globalization and free trade, very prominent in the makeup and the structure of today's economy. Not only Australia's economy, but also globally across the world, free trade is having a greater impact, and it's playing a much bigger role. So decreasing the average tariff levels in Australia from 9% in 1995 to 1.2% in 2016. Right, so again, something important to note there, with tariffs being a form of protection, right? So there are tax on the foreign competitors that come in and want to sell their products. They have to pay a certain tax on top of their product, which is normally then passed on to consumers. So the volume of exports increased by 8.6%, and Australia's GDP increased by $4 billion. As a result of that. So we can see the huge role that free trade actually plays to Australia's economy and Australia's economic success as well. In saying that, does not necessarily mean that all protection has disappeared. For example, some subsidies still remain, which is like government funds basically to help local businesses. For example, Australian government subsidies to farmers to increase international competitiveness for the farmers. as food prices can be quite volatile, especially after events such as floods and other natural disasters. So that's something that they do to help. So, for example, Austrade provides financial assistance, technical and marketing advice, and EMDGs, which are essentially grants, which reimburse exporters for costs relating to promotion of exports into new markets. So that's an example of subsidies that are provided to local businesses to help them get out there and be internationally competitive. So it's not like Australia has completely gotten rid of protection in the economy. So each dollar spent generates about $13.50 for $27 worth of exports. All right, so having a look at some of the free trade agreements. So we've got bilateral agreements. So bilateral trade agreements is basically an agreement between two countries. So, for example, Australia has negotiated many free trade agreements with countries such as New Zealand, Thailand, Singapore, US, Chile, Korea, China, etc. So a range of different countries. We've got free trade agreements with a range of different countries. Bilateral agreements are effective in encouraging increased trade between two countries. So if it's between Australia and the US, just honestly just encouraging trade between those two countries becomes a lot easier because of that free trade agreement. So an advantage of a bilateral trade agreement is that they are completed and implemented quickly because really you just need two signatures, right? So a disadvantage, however, is that it adds to complexity of international trade because now there's really just that relationship between the two people. There's too many different trading relationships, which can be quite difficult to manage. So we'll go through some examples of bilateral trade agreements. The first one we have is China and Australia Free Trade Agreement. This was created in 2015 to promote free trade. So 86% of Australia's exports to China are tariff free, and they intend to increase it to 98% in order to improve international competitiveness. There has, however, been a little bit of like a problem in recent times between China and Australia and their trading relationship, I guess at the back end or at the start of COVID. And so that's majorly impacted their trading relationship with China not buying, I think, barley and wheat and wine, I think it was, from Australia. And so there's been a bit of tension in terms of trade, which you can definitely do more research on. So Australia has granted greater market access for, education. So a lot of international students will come in from China to be educated in Australia. And so this means that China gains improved access to investment in Australia as well. However, many articles have noted that there's been major controversy in terms of Chinese companies bringing in migrant workers to work on major projects. So that's something to note as well. So I think it's quite important to take this into consideration and I guess just have a look into the relationship between Australia and China because they are Australia's major trading partner, right? They are the biggest trading partner of Australia, and so their role is quite important as well. So any tensions that do arise between the two countries can be extremely detrimental to both countries. Another example of a bilateral trade agreement that is quite prominent is the one between Australia and the US. This has been effective since 2005. It provides significant tariff reductions on goods in sectors such as agriculture and manufacturing. So automotive tariffs were eliminated completely, and tariffs on goods from 2013 were also eliminated. So the US is Australia's second largest trading partner after China and constitutes about 9.6% of Australia's two-way trade. So definitely provide updates in those stats as time progresses as well. All right, then we go into multilateral trade agreements. So this is rather than just having two countries, it's a range of different countries, like a bunch of different countries that sort of group together in order to improve free trade and achieve free trade between those countries and as a region. Normally, a lot of the time, it's based on geographic regions. So your location of where you are, like the Asia Pacific, for example, is looking at that specific geographic region. So this first one we've got is the Asia Pacific Economic Cooperation. So this is also referred to as APEC. This is a cooperative effort of 21 countries with a common goal of improving free trade in this region. So first established in 1989, APEC has facilitated and improved trade amongst its member countries. So essentially just helping free trade and so sort of trading goods has become a lot easier between them. So over 50% of the gross world product actually comes from member nations of APEC. So you can see that this is quite an important cooperation and free trade agreement. So you can definitely use your notes from topic 1 to help you out with this as well. So Asian is another one. This is the Australia-New Zealand Free Trade Agreement. Sorry, should not say Asian. It's the Australia-New Zealand Free Trade Agreement, and ZAFTA is also another one. So currently, Australia's main free trade agreement. So actually, they are combined. Apologies. I'm getting confused. So Asian is a part of the Australia-New Zealand Free Trade Agreement. So it's established in 2009, consists of 12 member nations. So the of the members, basically accounting for 20% of Australia's total trade in goods and services, which is a huge chunk of Australia's total trade, right? So prior to 2010, only 67% of Australia's exports to NZAFTA members were tariff-free, so there was no tax on the imports. By 2020, 96% will be tariff-free, as protection is reduced specifically on agriculture and pharmaceuticals, which are major exports for Australia. So there's a reduction in protection of export markets, which will boost the Australian economy by about $19 billion. So that's something important to note as well. So let's have a look at the implication of the Australian protectionist policies in terms of the 3 different levels. So we've got the individual level, and then we've got the firms level, and we've got the government level, and we'll talk about each one. So individually, structural unemployment in the short term and import competing industries will occur. So we can see why, right? Because we've got free trade that's taking place, there will be a structural unemployment. So we need to restructure the industries, and we need to cut local production. For example, we went through that with the car industry, because now the car industry is very much not prominent in Australia. We don't really have a car industry in Australia as much anymore. Long term, however, erosions of skill principle, the idea that long-term unemployed may increase, job opportunities will also increase, right? Because those industries that are very efficient and export competing, they will hire more people, and there's going to be a wider variety of goods and services for individuals to access as well. So lower prices, improved living standards, because now you have more options. You have the options of both going and buying from a local producer and a foreign producer. Then we move on to firms. So with firms, we've got short-term restructuring might be necessary, so forced innovation and competitiveness, shrink of import competing industries, so they cannot compete internationally. Those businesses will then close down, so that's going to impact firms. And there's also going to be a loss of profits in the short term, so whilst restructuring necessary. So long term, however, we see that things will improve. So basically higher overall competition and higher productivity, and this should say may lower. Let me just fix that. So it may lower input costs for other firms that use imported goods as well, right? So something to have a think about there. So please do consider noting these down, because again, you want to make sure that you consider long-term and short-term impacts, because these are often different. Something that happens immediately with short-term impacts will very quickly and drastically change to long-term impacts as well. So that's something to really take into consideration. And then finally, we've got government. So, short term, reduced government revenue due to decreased tariffs and tax collection, right? So, because remember that tariffs are reduced because they are a protectionist method and we're trying to encourage free trade. So, those two ideologies clash, and because we're trying to encourage free trade, there will be less tariffs. So, essentially, that will mean less revenue for the government. The government spending may increase in subsidies to retrenched workers and political consequences, right? So governments may lose votes by reducing protection, etc. So that may be a short-term impact to take into consideration as well. And in the long term, we've got sustainable economic growth. So this should raise revenue in the future as the economy becomes more efficient and can, essentially become more efficient in the future as well. So, although in the short term you're likely to face some consequences, we're likely to see an increase in efficiency in the long term, which is beneficial, and which is an advantage of free trade in the economy. All right, and then we look at implications for other countries. So, high domestic protection, like if Australia was very protective of their local businesses, then retaliation is going to occur from other international economies. So, if we're very, very, very protective of our local businesses, then chances are when we go and try to export our products to another country, that country will also be very protective of their local businesses, making it hard for you to go and export as Australians to go and export in that country. So Australia has played an active role in the WTO, which is also known as the World Trade Organization, to achieve reductions in agricultural subsidies which distort agricultural prices. So EU farmers are able to produce at a cheaper price, and they deny market access to efficient exporters like Australia. So that has caused quite a bit of an issue and quite a bit of a stir, which Australia has been sort of taken up with the WTO. So, protectionist policies such as tariffs on Australia's exports will help reduce sort of exports and lessen GDP of the Australian economy. So that's something to take into consideration, right? So do we really want that? And of course, there are advantages and disadvantages to both, to having protectionist policies and to not having protectionist policies and encouraging free trade. Now, these are two conflicting and two competing ideas that we need to make sure that we weigh up our positives and our negatives, our advantages and our disadvantages, and go from there. All right, and that sort of concludes the content component of today's lesson, or today's lecture rather. So hopefully you've gained some deeper insights into what that includes, like what these different topics include. So we went through a range of different topics. If I go right back to the start. So we went through Australia's trade and financial flows, we went through exchange rate movements, and then we also went through free trade and protection. So hopefully you're finding that you are feeling a lot more confident in these three topics and you now understand them more clearly. So just keep in mind that these three topics can, obviously they are quite important. So make sure that you are continuously revising and making sure that you do understand all the different components involved in them, because obviously they can come up in the HSC papers and assessments and etc. So in saying that, we will now go into exam tips and tricks. So a few exam prep tips to take into consideration to help you out. First of all is to just be present in class, right? So the more that you listen, the more that you'll need to, the less you'll need to revise. So it's quite important to make sure that you do understand what you're learning. Like, be present in class, make sure that you're reading the textbook, make sure you're asking the right questions. Just ask any questions. Like, if you feel unsure, ask questions, because they are your teachers and tutors and whoever is teaching you are there at the end of the day to help you out, right? So make sure that you do listen in class and make sure that you do understand. And once you grasp those concepts, it's very easy to then go and revise them. You know, when it comes time to HSC or assessments or exams, etc. So, second point to take into consideration is to find your best study method. So, I prefer to learn by reading and writing notes. Some people prefer to do practice papers. Others make visual graphics. Like another thing that I did was I would make visual graphics, like draw things, etc., to help me understand different concepts. That was just me personally. Obviously, to each their own. Like each person is different, and each person will have a different way of learning. It's very important that you find out what the best way to learn is, and that will not only benefit you in economics but also in all of your other subjects, because once you have a preferred learning method, you can sort of incorporate that into all of your different subjects and achieve success there as well. Obviously, in saying that, practice papers are probably one of the most important things that you can do. So please go onto the NESA website, type in your HSC, from I believe from 2012 onwards or 2011 onwards, all the papers are from the current syllabus. So just attempt all of those papers, and they give you the best insight into what your questions will be like in your HSC exam and your trials, etc. So I would highly recommend doing heaps and heaps and heaps of practice papers to get you accustomed to what sort of questions are asked, and then also to go through the marking guidelines of those practice questions. So go through the marking guidelines, see where you would put yourself, right? So would you put yourself in the band 6 region? Would you put yourself in the band 5 region, and why? What can you improve, and how can you get up, and how can you get as many marks as possible? Another very important tip that I would highly recommend that you integrate into your study routine, or just have a think about really, is understanding over memorizing. And this is easier said than done. I know how easy it is to literally just go, you know what, I'll just memorize all of this, it's fine. But honestly, understanding is much more important, because once you understand something, it will come to you more naturally to just be able to recall it and relay it on paper. So make an effort to think deeply about the content that you learn. Right, so essentially being able to form your own judgments in class, to be able to engage in discussion, these are all things that will help you think deeply about your content. So what do you think about this certain topic? What do you think about that, right? So and a really good way is through your essay questions, right? So your essay questions will almost always allow you to form judgments. They will always ask you to form a judgment. So have a look at your past HSC papers as well, and they will really enable you to achieve that. Because remember, memorizing is good, like it will help you out, but only to a certain level. Like for example, in your essays, you need to show a level of understanding in order to get those higher bands, right? So you need to be able to think deeply about the content that you've learned. What does it mean? What are your opinions? So as you're going through the content anyway, that's something to start incorporating into your routine and into your study habits as well. Next off, you've got collating important stats in a form of a form that is easy to memorize. So whether that be graphics, right? So if you work well with graphics, like please go ahead and use those. You can use a document to collate all of the important information. You can do a summary table, whatever works best for you. But make sure that you are collating important stats, and you are starting from now, from today. Right, so make sure that you're collating those important stats, because you will thank yourself when you are approaching trials in HSC that you started collating those stats from now, right? Because they are a really good way to boost up your marks and to prevent having to memorize heaps and heaps of stats the day before the HSC, the day before your trials, right? It's not a good way to go about it. So just starting early will help you out. You can also do like a timeline. So From 1990s to 2000s, these are the major events. From 2000 to 2005, these are the major events. So you can write about the mining boom, have a few stats there. And then from 2005 to 2010, these are the major events. Talk about the GFC, talk about post-mining boom, etc. From 2010 to 2015, this is what happened. Nothing really happened between those two periods that was too major, but you can just talk about how there's been a stable economic growth. 2015 to 2023, what's happened there? Well, a big one, COVID, we've got floods, we've got bushfires, there's a huge range of things that you can discuss that's had an impact on the economy and in Australia overall. So talk about that in terms of Australia, but also in terms of globally. What are the roles, what are the impacts, and what are the big questions to consider? And finally, to become familiar with your syllabus and to write essay plans is really, really, really important, right? So you want to be able to really become familiar with your syllabus. So be able to create understanding of what your syllabus includes, be able to identify which areas you are confident with, which areas you need help with, and then the areas you need help with, highlight them. Go to your tutor, go to your teacher, research online, write notes, look at your textbook, whatever it is, just make sure that you know and you understand each component, because your syllabus is where your questions are coming from. And if you don't know your syllabus, you are really, really going to struggle come exam time, come trials time, right? So make sure you know that. And another huge piece of advice that I will give you is related to your ability to write essay plans. So you want to be able to effectively write essay plans. So you're given a question, break down the question. So first of all, what is the HSC verb? If it says evaluate, analyze, what does it actually mean? How can you find out if you're not sure? Go onto the NESA website, type into Google NESA HSC glossary terms, and literally it will give you a summary of what each of the HSC verbs are and what they mean and how you can effectively answer it. And then you want to write out an essay plan. So introduction, briefly, what would I include? First paragraph, briefly, like write bullet points of what you would talk about in each point. And the same thing for the second, the third, the fourth, however many paragraphs you're writing. Same thing for conclusion. Especially when you're short on time or you want to get a bit of essay practice in for economics, but you don't want to be spending 40, 45, 50 minutes writing out an essay. This you can easily sort of get out in 20 minutes, 10, 20 minutes, depending on how detailed your essay plan is. So it's a really good way to encourage you to start thinking about your essay writing skills. And then obviously when you do get the time, you can put all your essay plans like in a folder, and when you do get the time, you can use that essay plan to write out an actual essay. And this is also really good advice in terms of making sure you have an essay plan in your exam as well. So for my exams, what I did with economics was I would always, during my reading time, flip to the last page, have a look at my essay question, think about the essays that I wanted to write when you're given the option, and then also basically choose the essays questions that I wanted to write on. And then as soon as writing time started, I would note down the important stats, I would note down the important points that I want to talk about in my essay, so that they wouldn't leave my mind if I then decided to go do multiple choice first. At least you have some sort of a plan to come back to when you start writing out your essay. Okay, so those are some tips and some advice that I would give to you in terms of exam prep to have a think about. All right, essay tips specifically to have a think about, right? So your essays make up a significant portion of your economics exam. So you've got to write 2 essays, which is going to be quite difficult if you don't have a plan or if you've never done practice essays before. So you want to make sure that you really, really, really do consider writing out a proper essay, and you do consider making sure that you're practicing constantly how to write a good essay. So the first thing we're going to think about is always planning. So you're always going to want to plan out your response. as I mentioned earlier, planning out your response is so important to success in economics, right? If you don't have a proper plan, chances are you'll get confused, you won't know what to talk about, etc., and that will significantly impact your ability to write a good essay, right? So always make sure that you have some sort of a plan. Next thing to consider is normally complex sentences are not rewarded. So please make sure that you are considering that you do not overcomplicate your responses, and you do take that into consideration. One sec. So do take that into consideration that you want to try and simplify your responses as much as possible. So if you are not considering that, like you do want to make sure that your responses are not overly complicated, because you're not going to get rewarded for that. Chances are the marker will see that and go, like, it doesn't make sense, right? So you can just make sure that your responses are as simple as possible. Clarity, so make sure that you use business or not business terminology, but economic terminology. You use syllabus terminology. You make sure that your responses make sense in terms of that as well. Graphs, so make sure that your graphs are integrated into your responses. Graphs are really, really important, and they are really integral to success in HSC economics. So that's something to consider. Integrating into your responses as well. Make sure that you're succinct and that you don't necessarily use slang, but you are succinct in your responses. Theory versus fact. So using words like may, might, could, theoretically, etc. Right? Those terms are really important, and they are really integral to achieving success in the course. So yeah, maybe try to avoid using try to avoid using terms where you don't sound confident in, like may, or this can lead to this may lead to this, right? So try to be more confident, but also think about, in economics specifically, you've got theory versus fact, where theory oftentimes is very different to what actually happens in the economy, because theory is just an example of what can potentially happen. So in that situation, you are okay to use terms like may, might, could, theoretically, etc. Then you've got counter arguments. So 70% argue for, 30% argue against, for example. Just depends on what sort of arguments you want to make and what points you're trying to make in your response. I would always recommend to, if it says evaluate, always have a judgment, always have an opinion, even if you are 100% for, that's fine. Just have some sort of an opinion. It just depends on what the question is, what your opinion is, right? So how much are you for? How much are you against? You can always integrate however statements. However statements are really, really important, and they are really integral to achieving success in the course. So ensuring that you are able to provide some sort of a counter argument. You're able to say something to show your knowledge and your understanding, instead of just splurging out content all the time. So know the NESA verb definitions as well. So make sure that, as I mentioned earlier, you go onto the NESA website, have a look at the HSC verbs, and just do look into that in terms of what different verbs mean, how you're able to effectively answer those. Some verbs are more commonly assessed, so have a look at the ones that are more commonly assessed in the economics HSC papers, and then you can sort of go from there. So stats, so you must not just state something, you need to make sure you go into a deeper level of analysis, right? So you want to be able to analyze something in a lot more detail, right? So treat it like a quote from English, right? So you want to follow the Peel method. Or something along those lines. Doesn't have to be exactly that, but you need to have stats in your response, which is why I've been sort of going on and on about stats and news updates and news articles throughout today's lecture, right? So you want to make sure that you have that in your response. And finally, wide reading quotes. So please do like your readings, read articles, read news updates, read all of those things, because they will be so beneficial to success in this course when you're able to integrate, analysis and relevant terminology, and provide opinions from experts, things like that, into your responses briefly. Does not have to be something major, but it's something that can really be helpful to you in terms of bettering your response. Right, so those are the main sort of tips and tricks in terms of an essay that I would give you. So those are definitely things that you can think about integrating into your responses to help you out as much as possible. So yeah, that basically concludes the tips and tricks section of today's lecture, and it brings us to the end of today's lecture. So as you may already be aware of, basically at the end of this lecture, so you've watched the recording, and then there's a Q&A component as well, which will be live. So if you do have any questions or anything specific you'd like to ask, that would be a great time to ask, and yeah, basically just a chill session to ask any questions, to make any comments, anything like that that you are interested in asking me, etc. So yeah, that sort of concludes that session. So just want to go back and recap very quickly some of the important points in terms of ATAR notes. So ATAR notes, quickly, we went through some of the free resources, which again you can access via atarnotes.com/register. So again, just to summarize, we've got study notes, we've got lectures, we've got discussions that you can sort of be a part of, or you can have a read of if you're confused about certain things. And this is not just limited to like content for subjects, like it is also including like university topics, etc. We've also got loads of engaging videos, newsletters, articles with study strategies and tips, not only for economics but for a range of different subjects. So if you have not already had a look through the other ATAR Notes lectures for the other subjects, please do feel free to go ahead and look at those, because we've got a bunch. We've got like for maths, business, legal studies, etc. So we've got a range, we've got like all of the sciences, most of the sciences, I believe. So it's really, really helpful for you as a student to sort of check those out as well, and to consider that as an option. And then also some of our paid resources as well to consider. So TuteSmart, which is our online tutoring, where you can sort of either sort of sign up for weekly classes where although you may feel like, oh, well, half of the year's gone by, well, you've got all the recordings for the previous classes as well that you can access. And you've also got private tutoring, which is one-on-one tutoring for an hour, and then you can book in tentatively or have in booked in every week, depending on what you prefer. And then study guides. So we've got study guides for economics as well. So if you are interested in those, they're really good at sort of summarizing key information, because I know the economics textbook is quite thick and quite a lot to get through. So having study guides can be very, very helpful because they're quite thin and they summarize the information very well. And finally, Ed Unlimited, which is hundreds of top study guides all in one place. So Ed Unlimited is an online platform. It's basically like yeah, you've got like all of the textbook, all of the study guides all in one place that you can access, you can highlight, etc. So, and that's not only limited to economics. Again, like you've got like your English text-specific study guide. So, for example, if you're studying 1984, you've got a text-specific guide for 1984. If you're studying T.S. Eliot, you've got text-specific guides for Eliot's poems, etc. So they've also got it for like the sciences, which I know can sometimes be very content heavy and quite a lot of information to get through. They've also got it for business, and for business I would also very highly recommend that you have a look through that, because the business ones are very good at providing like case bases, case studies, etc. as well. So yeah, I just wanted to sort of reiterate some of the resources that we do have outside of these lectures as well. So yeah, I think that pretty much concludes today's lecture. So thank you so much for listening in, and yeah, hopefully all goes well in terms of the rest of your HSC journey. And if you do have any questions, feel free to pop in to my Q&A, which will be occurring later on.